Brett, it's great to have you back in the studio, man.
Thanks, Jay. Thanks for having me.
Okay, so there's a handful of directions I want to go today, lots that I want to pick your brain on. And I think that we have to start with what I believe is the biggest transaction ever in the mining royalty business, which is obviously the Royal Gold takeover of Sandstorm. And so for anybody who maybe didn't see that, Sandstorm Royalty is a company that Nolan Watson and his partner David Aram founded and built through like the toughest part of the bear market, right? 2013, 14, 15 is when they really assembled this company. And a few weeks ago, they were acquired by Royal in a $3.5 billion all-stock transaction. Give me your thoughts on that deal. Like, if you're a Sandstorm shareholder, do you like that deal? If you're a Royal shareholder, do you like that deal? And what can you share about the mechanics and significance of it, Brett?
I'll give a little bit of background on kind of just what I think is happening on the sector, and then
Please.
I think get into some of those details. And I think what we're witnessing right now is a bit of an acceleration in a trend that's been in place, which is consolidation within the royalty sector.
Yeah.
But something changed this last year. And from 2024, January 2024 till today, we witnessed the majors market cap increase by approximately $30 billion. Now, to put that in perspective, it took about 40 years for the royalty sector as a whole to get to about 30 billion of combined market cap.
Right.
So in 1 year, they increased. Now with the metal prices
that's just the major royalty companies.
That's all the royalty companies, or just the majors as the 30 billion market cap increase, just three companies. When you look at the revenues now and the free cash that these companies are spinning off on a combined basis, it's north of $4 billion a year.
Right.
So what we're witnessing is really kind of a symptom of the opportunity set, because as these companies have become so much larger and their cash flows have grown so much, given the gold price, given the leverage that is kind of ultimately within these businesses, that it's very difficult to redeploy that amount of capital. Because the opportunity set, again, kind of remain the same. And so as those businesses have scaled, and you look around to kind of see what can really make a material impact, all of a sudden, M&A makes a lot more sense.
So that's interesting. It's kind of tough to find the best home to redeploy that capital, because you could do similar deals that you did the previous decade, but they're less accretive, right? They're going to make less of a material impact on the business. But there's been this surge of new royalty companies over the last 5 years, 10 years, right? And that's the better use of your growth dollars, right? Is to pick some of those up.
Well, it's the ability to make a material impact on your business when you're looking at kind of what the opportunity set is. So, a typical transaction for a major royalty company, would be 2, 3, 4, 500 million kind of range. And that's what we've seen over the last kind of 10 years or so. And based on their business and based on their market caps and based on their free cash, those types of deals were good, kind of solid little stair-step increases in being able to grow and provide growth for your shareholders and your business. But there was such a kind of significant increase in a very short period of time with the gold price that that drove a very significant expansion in free cash on these businesses. And so ultimately, when they're looking around, there's not a lot of businesses or opportunities that are available to really kind of make that impact. And I think that's put a bit of tension within kind of the mid-tier part of the sector.
Really? So would you expect, okay, that's interesting. I want to pull on that thread a bit. With the Sandstorm Royal acquisition, $3.5 billion all-stock transaction, what are your thoughts on that deal? From the timing, I know a lot of Sandstorm shareholders feel like, well, that's just what I've heard. They feel like they should have held on a bit longer as the market matured. How do you interpret it, though? Like, what's your take?
Well, there's two answers to that question. Obviously, the way that the stocks trade, I think, is mostly driven by basically merger arb funds that move the share price around for various different reasons, trying to capture that arb.
Yeah.
But when you look at kind of how the companies fit together, I think it's a great transaction. You've got Sandstorm, which had a lot of growth built into their portfolio. Growth is very difficult to buy today, especially when the gold price has gone from $2,000 to $3,300 in 18 months. And with Royal in their balance sheet, basically they can absorb a lot of the call it hangovers that kind of Sandstorm was working through. And they were doing a great job working through all that, but it kind of just erases all of that at once, kind of as a combined business. So ultimately, I think that the transaction will work out well for shareholders for both.
Okay, now can I get you to expand on the tension in the mid-tier royalty sector that you mentioned? What exactly does that mean, and what could individuals watching the royalty space expect to occur as a consequence?
What I can say is just there's a very limited opportunity set. And so the Royal Sandstorm transaction was a bit of a domino, if you will, that fell. That I think will increase kind of how these larger companies are kind of looking at the space and the opportunities that are available. And ultimately, I think that filters down to smaller businesses as well, like ours.
I would interpret that to say, like, everybody else is watching Royal's takeover and probably feeling a bit of pressure to find something similar to do, right? To express to their shareholders, we're going to find similar aggressive opportunities to grow. And that's the domino that Royal tipped over. And everybody else is watching this transaction, looking for something similar, but there's not a lot, right? As you mentioned, there's not a lot of deals to be done, which is where that tension comes from. General thoughts on the gold sector. So price has been ripping. That's not normal for gold, right? Here we are at like all-time highs, and that is beginning to trickle down through the equities. The best-in-class majors, royalty companies, and mid-tier producers are now all rising in price. Do you expect the gold price from here to stay a bit range-bound, at a very healthy price, I would argue? I don't think it has to go higher, but it might. What's your take on that? And then just, I always hear from investors that are impatient that the equities aren't ripping when they feel like they should, right? Gold's at all-time highs. Why aren't the explorers running yet? I interpret this bull market as like a textbook bull market. The gold price began to take off about 18 months ago, 2 years ago. The best-in-class majors and royalty companies followed suit. The mid-tiers are next. The funded developers are catching a bit. And it's like very logical and sequential to me. But everybody's always impatient. So what's your thoughts, gold price moving forward, in general health of the gold and silver equities market?
So I'll cover the gold market first. And, gold has always been viewed, I think over the last 20 years as kind of a hedge, a hedge against volatility, a hedge against geopolitical events, a hedge against kind of monetary debasement. It's always kind of been viewed as a hedge or almost like an insurance type of policy. I'm sure you've heard this before. I want to have 3, 4, 5% of gold exposure in the portfolio. That's kind of how it's been viewed.
Yeah.
That's changed. And that's changed as recent, I think, within the last 6 months is when I've really seen kind of the perception change around gold. And what has happened is there's been a structural shift where gold is no longer seen as a hedge. It's seen as the de facto global reserve asset. And if you think about that and kind of what the implications are, if gold is the de facto reserve asset, then what does that do to the price? And how does that position the central banks of the world, the big sovereign wealth funds of the world, in allocating their foreign reserves, their forex reserves, amongst all these different types of assets right now? U.S. Treasuries and kind of U.S. dollar denominated assets are the largest part of it. Now, what we just saw in the last few months is we saw gold overtake the euro as the second kind of largest portion of forex reserves globally. So euro is kind of right around 20%. Gold now is just a slightly over 20% of forex reserves. And if gold is going to become the global de facto reserve asset, you got to think about it. What percentage does that really need to get to? And in my view, it needs to get to about 50%. I think 50% of global reserves will at some point be made up of gold. Now, that is going to require gold to go up. That's going to require central banks to probably continue to buy more, some combination thereof. But when you kind of think about that, we're really just in the middle of it. We've seen gold go from 2,000, just to get to 50%. I estimate like probably somewhere between 6,000 and 8,000. Now, that is really a moving number because it all depends on how much the kind of currencies are debased globally. Yeah. And a number of other things. So that number can change. But if everything remains static today, I would say gold would probably need to rise somewhere between $6,000 and $8,000 an ounce to be able to kind of make up that 50% reserve amongst all kind of foreign held reserves. Yeah. And I think that's where it's at. So I continue to expect gold to go higher. It doesn't mean that you're not going to get consolidations along the way. It doesn't mean you're not going to get violent pullbacks along the way, but I think the pullbacks and the consolidations are going to become shorter. Mm-hmm. And there's going to be strong bids kind of along the way. Because when you look at kind of, again, particularly when you look at the emerging markets and the percentage of gold as reserves for them versus kind of the Western governments, it's significantly smaller. Yeah. Where you got Western governments, major, US, UK, France, Germany, like the percentage of gold is like well above 50%, where you look at, China and India and Brazil and a lot of the other emerging markets around the world, and it's still sub 20. So I think that we will continue to see a strong bid underneath gold. And again, like I think the pullbacks and the consolidations are going to be short, and it'll continue to march higher.
Now, for a lot of my viewers, they'll probably have a high level understanding of why you have that thesis, but I'd love you to maybe outline the case a little bit. What are the global macro driving forces that are pushing gold over that 20% right now, and in your estimation will continue until we're around 50%? And maybe a student of history would say, well, that's a reversion to the mean. Actually, that's not the anomaly if we go back and study currencies. But what's your take on those driving macro forces, Brett?
The core part of it is just the global view, the global world's view of the risk profile of U.S. Treasuries. Yeah. That's really the driving force. And because that is currently the global reserve asset. That is the largest portion of global reserves today. If you look around the world, it's been the largest portion for decades and decades. Yeah. But what's happened is kind of a twofold thing that's happened over a number of years. It really started when the Biden administration weaponized the dollar through sanctions, seizing private assets from Russians and so forth. And then that kind of snowballed into the Trump administration with all of the tariff uncertainty. And a lot of governments around the world kind of looking at this volatility and saying, well, wait a second, what if the tariff's on us? Yeah. We hold all these treasuries and they can be frozen. Yeah. So it's a really sensible thing when you think about it. All of these governments around the world are kind of just managing their risk, just like any sensible asset allocator would do. Mm-hmm. And we're seeing that trend. And as that kind of trend continues, then you're going to see gold kind of emerge, I think, as the de facto reserve asset. And it needs to get to at least 50%.
That's how gold gets to $6,000 to $8,000.
Yeah. And I don't have necessarily a timeline on that. Yeah. But I do think we're kind of right in the middle of that. Yeah. Where, I think kind of when you look at where gold has moved and how quickly, a lot of investors have, I missed it, or, I wasn't able to participate. But actually it's not just this hedge anymore, where all of a sudden the hedge is no longer needed and gold kind of consolidates back down because people feel comfortable from a geopolitical perspective.
Completely agree. That comfort's not coming back, not in this decade. right? I firmly believe that.
Yeah.
Every year of the 2020s so far has thrown an absolute haymaker at us. We're only halfway through this decade. I think it's just getting started. But the reason I wanted you to expand on that thesis, for a mining investor, a gold investor, they're nodding their head because they know what you're talking about. But it still shocks me. I mean, I was just a couple weeks ago having lunch with a buddy, a very successful entrepreneur, made all his money in the real estate sector. He's wealthy and smart, but he doesn't understand my business whatsoever. And even made the comment at lunch, isn't it wild that people still, for some reason, want to buy gold? And it struck me as that's the gap right now, is that general population still does not understand the thesis or the why, right? And it'll occur because rising prices attract interest and buyers, and this will, I think, roll out. But it struck me that even though we're in a bull market, I feel like internally at Cambridge House right now, we're drinking through a fire hose. Like everything's happening all at once, but not for the gen pop. We're not even close to mainstream yet, right? This is still early innings for this sector. I firmly believe that.
Very early. And when you look at just one thing I like to always monitor are the capital flows. People talk about the equities and not performing.
Right.
Ultimately, there needs to be inflows. There needs to be more buyers and sellers for these stocks to go up.
Yeah.
When you look at the GDX and the GDXJ, still today, we've seen record outflows out of both of the two largest publicly traded ETFs that kind of cover the large gold companies and the small gold companies. Now,
is your take on that because people maybe got into those vehicles in 2022 at sort of all-time highs or recent highs, and then they got sucked into the 2023 correction, and this is the first foreseeable selling opportunity that looks reasonable to them, and they're trying to get out of these positions where they felt a bit trapped for the last couple of years? Or what's your take on that?
Well, when I talk to some of the largest mining specialist fund managers around the world, they're seeing the same type of activity.
Okay.
And what they make of it is that there are investors out there, there are generalist investors out there that are comfortable holding a certain percentage of gold exposure, kind of like we has discussed before, in their portfolio as insurance. Whether that's 2%, 3%, 5%, whatever it is, based on their own kind of asset allocation and risk models and so forth. When we've been seeing the equities materially outperform the rest of the market, the rest of the indexes, like across the board, their gold position is now gone from 5% to 6% to 7%. And what we're seeing just rebalancing by basically back to the 5. As it goes up, they're selling. And so it's not like fierce kind of active selling. It's more of just rebalancing from the significant outperformance that these equities have had in a number of those names. But even the GDXJ and the GDX, you've seen those perform very well over the last year, 18 months. And as they've been performing well, the AUM has been decreasing, which is wild to me. But that tells me that, to your point, like the generalist part of the market is nowhere to be seen yet. And when that finally does come back, I mean, you think about what that would do if those flows reverse and what that would do to the underlying performance of the equities. It could be very, very significant. But we are seeing signs for the first time now, since really 2020, of inflows into some of the juniors, inflows into silver. So you're seeing the relative outperformance on silver to gold. You're seeing the relative outperformance on the GDXJ versus the GDX. I can walk you through a number of different indicators. But what that tells you is that the view of these businesses, I believe, has changed. And I think that is being driven off of what we spoke about before with gold, where these investors are kind of all of a sudden looking at this and they're being like, well, wait a second. Gold's going to keep going higher. And what ultimately do these businesses look like over this period of time? And I think that has been kind of the shift in perception, in market perception, that is starting to start to drive those flows. And there are some unbelievable businesses, call it sub-billion market cap and below in this sector, that have not really made significant moves yet.
Right. Absolutely. Okay. I want to get your take on how ripe the mining industry is for disruption, like technological disruption, because I know you watch this closely, and it's an industry that kind of lags in terms of innovation often, right? Drills spin a bit faster than they did 100 years ago, but we're doing the same thing right now. On the margin, there's been like companies like Verify, adding new tech to the exploration process, the analysis process, expediting our ability to interpret historic results, all of this. What are you watching on the innovation front in the mining sector that you think really matters? Not just headlines and noise, but actually material for the industry.
As artificial intelligence increases and the productivity capacity of that increases, it is going to make a very significant impact in all businesses, in all sectors. But for the mining sector specifically, we see very significant increases in productivity. And what I mean by this is that, I think AI has been a way overhyped kind of whatever investment theme over the years, and people really don't fully understand the tech that is behind it, and really the rapid increase in how it's improving. I think people kind of look at AI today and it's a better form of search, or maybe it can organize things for me or be an assistant and so forth. But the rate of increase in these reasoning models is wild. You can tell a difference like month over month over month right now. And as these models start to be able to self-improve, which I just saw Mark Zuckerberg basically came out today and did a post basically saying, their models are now learning to self-improve. The exponential increase that the world will see in a very short period of time, I think is going to drive very significant changes and developments in everything, right? In energy, in healthcare, in all sectors. But for mining, what does that mean? Well, I think that means that 10 years from now, you probably will be able to put a mine in production with 30 people instead of thousands.
Yeah. Okay.
You won't need these huge camps. There will be no people that actually go underground and mine. So what does that mean? That means that the market kind of backdrop, or the macro backdrop with this business specifically, I think we will go through a period of lower costs for the first time. If you look at kind of the overall cost structure of mining going all the way back to 2020, it kind of continues to stay in this range, right? And nothing really kind of changed from the productivity part of that equation. But I think that over the next 10 years, there's going to be huge advancements in productivity, which means that there's going to be significant lower costs, which means that the margins of these businesses are going to expand. Right now, they're at record margins already. The average all-in sustaining cost today is around $1,500 an ounce. You've got gold over 3,000. That's a $1,500 an ounce margin. But what happens if we see gold move up and then these costs actually go down? And that's probably not going to happen in the short term, because there is a bit of inflation and the technology is not quite there yet. But by the end of this decade, I'm pretty confident that the technology will be there. And as that increases, then that flows into robotics, that flows into basically changing the way that you process, changing the way that you mine, changing the way that you monitor, and really being able to operate these massive projects with a small amount of people.
And that's the big pivot, is a small amount of people. It's cutting the labor costs down, right?
Significantly reducing costs. Yeah. And again, probably aren't going to see anything in the next few years. But when you look at this business over kind of a 10-year period, I think you're going to go through significant productivity, meaning we're going to go through kind of a cost kind of deflationary cycle. At the same time, you're going to see a very significant rise in the price, which is going to be a really solid macro setup. And just kind of, I think, changing the way that you really look at these businesses.
Right.
Mining, or the mining equities, has in comparison to kind of all financial assets and markets, has become kind of an insignificant part of the world. And that's changed. It used to be a very significant part of the world 20, 30, 40, 50 years ago. Now, not so much. You take NVIDIA is, I think I saw a stat that it's, 4 times like the top 50 global mining companies in market cap.
Yeah, okay, I'm not surprised.
So it's become very insignificant. But when you kind of look at this backdrop, you look at kind of what's happening, I think that's going to change.
Yeah. Well, I mean, some of the most successful and innovative companies over the last 15 years have all been like leasing businesses, subscription businesses, or membership platforms, all of this stuff, right? And the increased demand on material goods, it's not really been driven so much by that, but that is changing. I agree with you. And as we disrupt the labor force through more sort of autonomous tech, and I agree, it's not just mining, it's everywhere. What do you think about this? The pie chart of necessary inputs to create anything, whether it's put a mine into production or manufacture a good. There's a handful of things in that pie chart, and one of them is labor, one of them is energy, one of them is the material goods. But as the labor slice gets smaller, the energy slice gets bigger. And that's like this, I see that as a bit of a sleeping giant in energy demand. And it's going to be a massive driving force because whatever we replace humans with will be replaced by energy input. Right. And the demand is therefore, I think, very bullish.
I saw an interview with Eric Schmidt, the ex-CEO of Google, on going to Capitol Hill and talking to all the politicians about kind of the potential energy needed to be a leader in AI, because it's a bit of an arms race right now with all these governments, China, US, and so forth. They fully understand that whichever country reaches kind of this super intelligence phase that they talk about is going to have a very significant advantage kind of across everything. And one of the main things that Eric was talking about when he was talking to all the politicians was that the need for energy, and just planned data centers. So just data centers, AI infrastructure data centers today in the US is expected to use approximately 96 gigawatts of energy. That's the equivalent of about 100 new nuclear power plants.
Right.
That is just what's planned.
That's the scheduled data centers. Right.
Correct.
Right.
So you think about kind of, it's going to be more than that. And where are we going to get all this energy? Yeah. More importantly, what connects all of these as your second point was the resources part of it. And when we look at copper, now Metalla's made an acquisition, merging with Nova Royalty about 1.5 years ago to pick up a very significant part of kind of the key copper projects across North and South America, that we think will be a material part of this next build cycle, as we get into kind of the latter part of this decade. Copper is really interesting because I sat through and attended one of the top global banks kind of copper market outlook presentations a few weeks back. And I was listening to this, and nowhere in that data do they have any of the data center demand, which is expected to be kind of upwards of 500,000 tons per year, just by themselves. And then robotics isn't even a discussion. And when you think about kind of the advancements of AI and how that will kind of eventually get into robotics across every industry, copper is going to be the lifeblood on all of that. You take a look back at kind of what their outlook is. Copper is going to be in a structural deficit regardless of any new demand. Basically, I've seen kind of starting this year, next year, kind of within the next couple years, basically. And so you've got this structural deficit that's going to go out about a decade. And you've got this demand curve that I think is only going to exponentially increase as the world starts to change here. And there's going to be a crunch of probably 5, 6, maybe 7 years because it takes so long to put these mines in production. There's a dozen companies on the planet that can build these mines, and they can build one of them every 5 years.
Right.
And that's kind of it.
That's it.
So when you think about that, and you think about kind of what the effect is of that kind of over the long term from a copper perspective. Like I believe, I'm not going to give any price forecast, but I believe that, we will see copper have, a bull market for the history books. And eventually that'll stabilize. And I think there'll be breakthroughs, with new technology, with the productive kind of capacity across the mining sector. I think that the integration of artificial intelligence in the mining sector will also drive a new discovery cycle as well. So I think all of that eventually stabilizes, but I think there's going to be a period of time, probably between 2028 and 2034, where you're going to see quite a wild ride. And so when we look at our portfolio on that merger that we did back a year and a half ago, most of our copper assets are already in progress to start production kind of between 28 and 2034. And so we see that kind of lining up very, very well to kind of capture that potential upside.
So let's talk about that, because I think we sort of outlined a gold thesis that we both agree on, and we outlined a copper thesis that we both agree on, and a bigger energy thesis. The $1 million question is, how can we make money off this trend, right? That's the whole point of studying the commodities and supply and demand of raw materials, so you can position yourself in front of the avalanche, right? For somebody who's just walked in, a lot of my viewers know you and they know Metalla, but not everybody does. So give us the quick high-level overview of your business, Brett, and then I want to dive into some of the details and nuance.
Well, we're a royalty and streaming company. We've been around for coming up on 9 years. We have 100 assets in the portfolio. Right now, we're about 2/3 kind of weighted towards precious metals, mainly just gold and silver, and about 1/3 copper. And that was all by design. That was all by design based on kind of the macro setup and the macro kind of long-term tailwinds that we felt as a business we wanted to kind of position our shareholders for. And me, being one of the largest shareholders, and a lot of the big shareholders of our company have been big stakeholders since the very beginning. And so, this is something that we've kind of tactically very put together in a very thoughtful way to kind of position for what we see here. But for the viewers that aren't familiar with the royalty business as a whole, royalties are non-dilutive, free carried interests that go into perpetuity on mining assets that once they're in production, they deliver top line cash flow. So it's a way for investors to get better exposure to a broad group of different assets at various different stages. Ultimately, mines are depleting assets. When I hear investors talk about, mine or, valuing royalty or mining companies off a cash flow multiples. I'm like, well, wait a second. You can't give it a 20x multiple if the mine is out of production in 8 years.
Yeah.
It doesn't work.
Right.
And so, it's important to kind of, I think, look at it from, ultimately what the value is, what the kind of intrinsic value of the reserve in the ground, resources, ability for those to increase and so forth.
Yeah.
And so, thinking about all of that, what we did was we strategically stayed in the tier one kind of political jurisdictions. So North America, South America, Australia is where, primarily almost all of our value is kind of held. And that's important when you think about the macro backdrop. And this is because when you go through, if you look back in history, when you go through these periods of time where there's like a superpower change in regards to where it is, you go through periods of very significant geopolitical volatility. We're kind of seeing that, right? You see that Ukraine, you've been seeing that kind of Iran recently. And as the superpower kind of slowly falters, the rest of the world starts to kind of jockey for power.
Yeah, totally.
And they kind of faction off into different groups and so forth. But ultimately, what does that mean? That means you don't want to have assets in a bunch of jurisdictions that are kind of not in control of kind of good rule of law. I mean,
yes.
And in safer places.
Yes.
And so by design, that's where we focused on our assets. Now, the second part of it is making sure that those assets that you have exposure to on these royalty portfolio is being advanced by very solid operators.
Yeah.
And that is absolutely critical in this business, because there are a lot of smaller companies that don't have the balance sheet, don't have the skill sets, don't have the ability to kind of plan for decades instead of years.
Yeah.
And so it's important to have these companies, really be driving the value on the underlying assets, because we don't mine anything.
That's right.
As a royalty company, royalty and streaming companies, they don't mine anything. We simply hold these interests, and it doesn't matter how much equity that the mining company issues, from exploration to development to production along the way. The shares outstanding might go up, tenfold, but the interest that we have in that royalty stays at 1 or 2 or 3% all the way through.
Yes. Yeah.
So, good jurisdictions, great operators, and, finally, I think, and probably most important, great geology.
Right. Yeah.
And
okay.
focusing on the proven geological trends around the world, and taking that longer term view. And that's how we built our business. When you look at our portfolio today, in order to give our shareholders exposure to those premier assets, we had to buy stuff that was a little bit further out from production. And as a small company, that's where we found our competitive edge, to be able to find, source, execute, and acquire reasonable to attractive valuations. Where, once an asset's in production, then there's a lot of eyeballs on it. It's a high profile. It's a very kind of competitive environment.
Yeah.
And the inability to be able to kind of find those types of assets that are producing is very kind of few and far between. We've seen a small handful of those over the last 10 years, even available, because most of those companies, they're not encumbering those assets with royalty or stream financing. So most of that's kind of third party type of acquisitions.
That's why I think it's so important for investors to start with royalty companies when they're building a portfolio. And this was restated. We just hosted a mastermind for our commodity university students, and Adrian Day was sharing that exact concept. He's like, you want to start with some physical, and the next thing you should buy are royalty companies. And part of the reason is because you're doing what I'm doing, right? Just at a much larger scale. I'm looking to allocate capital. And what a royalty company does is you provide capital now in exchange for revenue later, right? Mining's very expensive. It's very expensive to find gold, find copper, and then very expensive to build the mine. They always need cash. You provide that cash in exchange for a percent of the revenue down the road. I completely agree on the jurisdiction front. And we talked about central banks buying gold in record numbers, and we're watching this now. I'm sure we're going to see this. There will be increased incidence of countries who have not been able to acquire gold at that rate and have a currency they can't just inflate because it'll devalue way too fast. But maybe there's a gold mine inside their borders, and they'll say, we're going to need that, right? It's bad politics, it's bad business, but our back's against the wall and we have to. And we're going to see an increase in nationalization from countries all over the world. And so very important right now, I think, to look at the history of governance and predictability of that. Because some countries couldn't afford to do that, right? Canada couldn't afford to nationalize a mine. I mean, God forbid, but it'd be unspeakable, right? It's not the case everywhere. And then you get into the operators. So you're allocating cash now for revenue later. Well, what's the promise or what's the probability of that revenue later? It all comes down to the operator. What's their track record of actually putting mines into production and keeping them in production and extending the mine life? And that's your process, which is what every investor should be doing. And that's why starting with royalty companies is the best place to start, because you're kind of like starting with that ace up your sleeve, the counsel who's making those decisions at scale, and inevitably has way more resources than any given investor, myself included. So when someone's looking at Metalla royalty, and I'd love to get your take on this, how would you suggest they begin to value your company? Because there's two things they should look at. They should look at your producing assets. So these are and when we say you've allocated capital, you said you've done over 100 deals in the portfolio today. Some of those are producing, right? They're generating revenue. That's your money. And some of those are in development. They're going to at some point in the future. And you have to look at both. As you mentioned, it's the pipeline. That's where the real upside is, right? The next term cash flow. When someone's looking at Metalla, how should they go about valuing this company? Off the producing assets, the pipeline, a bit of both, and what should they look at?
Well, let me just start off with, I think Adrian is one of the top royalty investors in the world. Definitely the most well-informed royalty investor and longest standing royalty investor around the world.
Yeah. He's
also one of our largest shareholders and provided the majority of the seed capital to start Metalla, and continues to hold a very meaningful position today in our business and a great supporter. Going to your question on kind of how we should look at this business, I think the best way to explain it is really a case study on kind of what we've done and kind of how we've looked at our business at different stages of kind of the life cycle. And in the early days, it was all about building foundation, because if you're building a royalty company, you have to have the diversification. You have to have that pipeline that you mentioned to be able to continue to kind of propel the business. And for the larger companies, it's all about playing the cycles. So if you think about the larger businesses, the Franco, Royal, and the Wheatons, what do they have that really everybody else does not? They've got exposure to very large, multi-decade assets. To do that in the royalty business is extremely difficult. We understood this at an early stage, and we said, okay, well, how are we going to set ourselves apart? We're going to focus a little bit earlier stage. We're going to use our competitive advantage where we have it. And it's going to take time. We're going to need to have some patient investors. We need to kind of manage our share register as such. And so that's what we did. And so a case study on this is the acquisition that we did on the Côté Gosselin royalty. So we have a 1.35% royalty that covers all of Gosselin. This is the third, basically on track to be the third largest gold mine. It's in production today. IAMGOLD is the operator. It's in Ontario. And we recognized that they discovered something very special. But at the time, they were in the middle of this build on Côté, which was having big cost overruns and so forth, and other things were happening. So it wasn't getting very much attention. But we noticed that if these results were coming out in an exploration company, like the stock would be up 10x. And so we quickly looked at that. We found royalties on that property. We acquired them, and we acquired them for a total of $6 million US. Now, this was pre-resource. So this is before there was any resource out on this project, but we knew there was something special there. Within 4.5 years, fast forward till today, that has gone from 0 to 7.4 million ounces of gold. And the attributable gold to Metalla off a $6 million investment is now approximately 120,000 ounces of gold. And we expect that to increase as early as, end of this year, with the expectation that IAMGOLD is going to update the reserves and resources for the Côté and Gosselin mine. We recently saw the largest royalty transaction ever made, with Franco-Nevada coming in and buying the gross margin part of that for $1 billion.
Right.
So there's been bigger streams, but that was the largest single royalty transaction ever. And Franco came in and they partnered with IAMGOLD as part of that process. They bought it from a third party. They did all their diligence and they wrote a very, very large check, understanding that in order to get to that valuation, there had to have been a view that this asset is going to get a lot bigger. And the growth part of that mine, our royalty covers 100% of this. Gosselin, right. Basically, that's the growth part of that asset. Ultimately, we see that integration of Gosselin into the mine plan in 26. I think that's going to daylight a lot of value. But that's how you go out and you spend $6 million on something that will ultimately probably kick off $200 or $300 or more $million over the life of this asset over many, many decades, getting exposure to assets that have this multi-cycle type of exposure, like the big royalty companies. Because once you get the multi-decade kind of long life assets in good jurisdictions, then you can play the cycles, and these cycles will go up. And if you look at the big royalty companies, most of their growth came in these little windows. So there was like an 18-month window in 2013 to 2015. There was the mining sector, all their balance sheets were kind of completely upside down, kind of after the 2011 bull market. They all needed capital. The royalty companies were there. They were patient. They stepped up and they deployed, I think in those 2 years, the big royalty companies deployed more capital than the entire TSXV raised combined.
Interesting. I didn't know that.
So it's about playing the cycles. And so when you look at our portfolio today, most of the value in Metalla is in development today. I think we're right around 12% of our NAV in production. And, the balance of that is basically development. Ultimately, now that we've gone through kind of a number of years building that foundational portfolio, that should increase to around 50% by the end of this decade. From 12% in production, kind of the NAV of the intrinsic value of the portfolio, to about 50% of the intrinsic value in the portfolio. And when I think about kind of what is a great kind of target on production to development, I think that 50% is the right number. Because again, you're in a world where if you've got 60, 70, 80% of your portfolio in production, well, you're going to have negative growth. And you're seeing that. I mean, Royal Gold Sandstorm is a perfect example of that. Heavy production profile, negative growth. Sandstorm comes in, fixes that. And so, ultimately, if you're looking at the business over the long term, you kind of want to have half of that value in development for the future, and you want to have half of it in production. So ultimately, I think we will get there by 2030. Currently today, the market is valuing development at insane discounts. And I believe that kind of is a function of the lack of really participants that are in this sector. I think that, again, there's not enough eyeballs, specifically on businesses that are sub-billion market cap. And that presents the opportunity for investors to roll up their sleeves and go out and find some of these amazing companies with this macro backdrop that we discussed earlier. But, development today in our portfolio, we kind of work backwards, and it's like, should there be a 14, 15, 16+% discount rate applied to the development? And when you look at the development, you're like, well, wait a second, Côté's in production. Like, Gosselin's going to be integrated. Like, ultimately, what is that risk and what is the discount rate that should be applied to that? You can kind of make that same statement for our entire development portfolio, because our development portfolio is being advanced by the largest mining companies in the world, right? Like the Agnicos, the Barricks, the Newmonts, the Tecs. These assets that are in our portfolio are core to their own pipeline and their own ability to replace the reserves that they're mining today. So these assets are going to have to advance. The timing is always, as you know, in mining, kind of give or take. But, we see that as the production starts to ramp up, that is going to pull that development NAV forward. At the same time, we have these significant kind of tailwinds, I think, over the next few years that are lining up very well for the portfolio that should position us, I think, to be kind of a new leader or a new mid-tier leader within the royalty sector, as you kind of on the landscape side, still going to have lots of pressure from M&A.
That's really interesting. I never thought about how you calculate sort of the weighting of your NAV on production versus development. And I might have thought about it, and I think probably still do. The heavier weighted you are on development, if it's high quality development, the bigger the opportunity for investors because of how that value is discounted, as you mentioned. That's my advantage, right? I can look at your pipeline. Who cares if the market's discounting it? That's my opportunity, because time will go by. Those operators will move to production. They're the Mark Bristow. If you trust Mark Bristow, that's Amar at Agnico, one of the most competent CEOs in the business, right? And they just last quarter earnings are 1.3 billion, massively overshot, right? He's a very conservative CEO, right? I think you can trust his forecast. And that's the opportunity to swoop in, because as you get closer, as that development begins to mature, it doesn't have to get to production. The market will recognize it probably before it does, right? The closer you get to those dates, the tighter that timeline gets, the market will pick up on that and begin to move in. I expect that's often what happens.
And you're absolutely correct. the market will kind of act in anticipation of all of these events happening. Like as they become more real, they will see that. One thing that I think, the market is not paying attention to is when you look at kind of the analysts and the banking community that kind of puts these, third-party objective valuations that all the institutions look at, there's a consensus gold price. And so when you look at kind of the consensus gold price today, for 2025, you're up around 3,000, and then it kind of tails off through 2029. And in 2029, which is considered the long-term gold price, it kind of flatlines there. This is how they're valuing the assets in our portfolio. And so when you look at our portfolio and you look at kind of the material amount of actual cash that's going to be coming out of this portfolio, it's like the big bulk part of it is going to be post kind of 2028.
Right.
Which means that the analysts are basically pricing the value of these assets off long term. So $2,500 gold today compared to where gold's trading today, which is around $3,300. Yeah. So there's almost $1,000 gap in the value of where kind of that's being marked today and kind of what the reality is.
Yeah.
And again, kind of looking at the overall intrinsic value of the business and kind of from that perspective on an NPV basis, that's a significant jump.
Yes.
That's a significant amount of value. Ultimately, like if you just look at what the difference would be if you use kind of 2025 consensus over the long term, you would see an increase in value that was almost our entire market cap today.
Right. Yeah. Okay. I want to talk about future growth, and big development on your end is your new credit facility. Run me through the material impact of that. What have you secured here? What's the purpose of it, and how does it change the balance sheet of the business?
The credit facility that we recently announced, it's a kind of combined $75 million US facility with Bank of Montreal and National Bank Financial as the lenders. It's got a $40 million base and a $35 million accordion. But the important part for investors is that this is the key tool to be able to scale as a larger royalty company. Again, I talked to you kind of about the different phases and the different strategies that we've had kind of growing from accumulation phase to now scaling phase.
Yeah.
And I believe we're in scaling phase today.
Okay.
If you look at our portfolio, if we do absolutely nothing, we should see a 30 to 35% CAGR in our gold production through our royalty portfolio through the end of this decade. So all of that is bought and paid for. But how do we kind of scale that from here? Having that cash flow build up has allowed us to get these big facilities, and looking at kind of credit as a new tool, or a reasonable cost of credit as a new tool to grow our business, it'll allow us to evaluate much larger transactions, and really scale as a mid-tier. Now, this is happening at the same time where we just saw one mid-tier basically disappear and get absorbed to a senior.
Yes.
This is happening at the same time where there's probably reasonable probability that the mid-tier part of the market looks a lot different in 12 months from now. I don't know what that looks like, but just kind of looking at what's happening generally, I believe may be an opportunity for Metalla to really scale into kind of being a very significant player within the sector. So that's very exciting. But it allows us to look at bigger transactions as kind of the main tool as credit, kind of as another kind of use of non-dilutive funding, which is another reason kind of where you get significant equity appreciation. When we were growing our business from scratch, we had no royalties at all. In 2016, we didn't start with anything. And you always have to fund your business. You're going out and acquiring. It's an acquisition growth business. So every single time you're acquiring assets, you're financing them, and you're financing them with equity. You're financing them with debt or convertibles or kind of combination thereof. But you have to go out and you have to finance these assets. Now, when you're doing that, your share count is going up. And so it's important that as management looks at these opportunities, that they're accretive, meaning that, if you buy something like Cote and Gosselin and you issue debt or equity to finance that, and it costs $6 million, and you fast forward 4 or 5 years, analyst consensus is in the 50 range. Ultimately, I think that goes, if you look at kind of the most recent Franco transaction and kind of the look-through value, it's probably north of 100. So it's important that management kind of carefully and in a disciplined fashion executes on an accretive basis. What does that mean? That means that even though there's more shares outstanding, that the value per share increases because what you bought is worth more than what you paid.
Yeah.
And if you look at kind of the analyst consensus NAV over the last 5 years, basically we've been able to grow our NAV basically almost double of what it was 5 years ago.
Right.
On a per share basis.
Yeah.
It's grown more than double, as a consolidated amount, but on a per share basis, if you own 100,000 shares of Metalla, on a per share basis, the intrinsic value of that has doubled over the last 5 years. And so that is based off smart, kind of focused, disciplined acquisitions, again, going to a part of the market that we had I felt strong competitive edge where we could execute, 32 different transactions, acquiring 100 royalties over 8 years. That was a lot of building. Yeah. If you look at the last 18 months, we've done nothing. And it's not that we couldn't have done transactions. We could have done multiple deals in 2024. But it just didn't make sense on a per share basis. We couldn't kind of make the math work. And it's always difficult in a period of time where the gold price is making very big swings. So that was kind of a time for us to kind of look back, really kind of get our business ready, I think, for the next phase of growth. And so we've done that. And part of that was the addition of this credit facility. And so, now we're kind of looking at the landscape. We're seeing big opportunities, that we never even would have dreamed of 2 or 3 years ago.
Okay. And so thank you for that. Prospective shareholders should stay up to date. You regularly publish portfolio updates as the development assets mature or anything material changes on the production front. Your 2025 asset handbook is out. So anybody who wants to dive deeper into those 100 plus agreements can do so and get a sense of, what each is doing. And you're hinting at maybe some material decisions in the future, right? You've got the capital to support it. $75 million credit line gives you a lot of options in this market, as we just discussed, where it's big deals that you're hunting for, which is exciting.
Yeah, we're excited. We feel very, very well positioned. It's always a tough thing because, originally when Metalla was first started, Adrian and others that were kind of the core investor team, I said, look, it's going to take 10 years to really build this business. And I think we're very close right now. I think we've got a substantial portfolio that will kick off cash probably through the end of the century if we do nothing, which is pretty incredible when you think about kind of 8 years of real work and kind of what this portfolio will generate over that period of time. But having exposure to these macro trends on the backdrop of these long life assets in tier 1 jurisdictions and the balance sheet strength that we were able to sort out this year with the addition of the credit facility and then the landscape opening up, we're excited. We're excited about what's to come. We think we'll be able to make big moves here, over the next couple of years, and we're really excited about it. You can find out more about our company on our website, metallaroyalty.com. And also our asset handbook, which was just published about a couple months back, is a great place to start, just to get a real quick understanding of all the different assets that we have. I sit down when you have 100 assets, it's a lot. Institutions aren't keeping track of all these, right? When you meet with institutions and we bring these asset handbooks and they flip through and they're like, whoa, I didn't know you owned this. I didn't know you owned this. I didn't know you owned this.
Yeah.
And 15 minutes in, looking through this asset handbook, they're pretty blown away about what we've been able to kind of put together.
Yeah.
So it's a great place for investors just to get a good feel of what we do and our assets and kind of the the business and in the future.
I love it. Yeah. And people should check it out, just as an education tool as well, because you can see the mechanics of every single deal and how they're all structured a little bit different, right? And really understand the business as a consequence. Brett, I'm stoked I was able to catch you while you're in Vancouver. It's always great catching up with you, and I look forward to next time.
Yeah, me too. Thanks, Jay.